You've probably heard this idea about those big, powerful platform businesses, that one company is just destined to win. Everyone else disappears. It's this all or nothing battle for monopoly. But that brings up a really interesting question. If that's true, how did a company like Uber spend billions of dollars trying to win, only to find itself still locked in this brutal fight with competitors? So, what actually determines if a market is going to tip to one winner? To get to the bottom of that, we have to start with the concept itself. Because the idea that every single one of these markets is destined to have just one winner is, well, in a lot of cases, it's a total myth. So, what is a winner-take-all market, really? In theory, it's pretty simple. One company comes in and just captures almost all the value, the customers, the profits, you name it. And everyone else is just left fighting over the crumbs. Think about Google and Cirque, right? They've got the lion's share. And how does this happen? Well, it's a process that experts call market tipping. It starts with a company getting just a small, early lead. But then that advantage starts to compound on itself. It reinforces itself, kind of like a snowball rolling downhill, getting bigger and bigger, until that one company becomes impossible to catch. And this, right here, is the absolute key to this whole explainer. That winner-take-all outcome, it's not a guarantee. And assuming every single market is going to tip can be a massive, and I mean incredibly expensive, mistake. So if not all markets are destined to have one winner, how do we know which ones will? Well, it turns out there are three key conditions, three tipping points that we really need to look for. Okay, so here are the three big ones. First, you need high multi-homing costs. That's just a fancy way of saying it's difficult or expensive for users to be on more than one platform at the same time. Second, you need really strong network effects. The service has to get way, way better for everybody as more people join. And third, users don't really care about variety. They pretty much all want the exact same thing from the surface. So here's the deal. If you get all three of those to line up perfectly, then yeah, the market is probably going to tip, and one winner is going to emerge. But, and this is a big but, if even one of those conditions isn't met, the whole dynamic just breaks down. You don't get a monopoly, you get competition that, frankly, never really goes away. All right, so let's take this exact framework and apply it to the ride-sharing industry. It's the perfect way to see why Uber, despite all the money and effort, just couldn't win it all. This is the billion-dollar question, isn't it? It's the one that investors and executives at Uber have been wrestling with for over a decade. So let's actually break it down. You know, the second you start looking at ride-sharing through this three-part lens, the whole winner-take-all case just starts to fall apart. Are multi-homing costs high? Absolutely not. Are the network effects strong? Well, yes, but there's a huge catch we're about to get to. And is there a low demand for different options? For the most part, yeah, but not entirely. And this is a perfect illustration of why the market doesn't tip. First, multi-homing is super easy. As a rider, you can have Uber and Lyft on your phone and just check both. As a driver, you can run both apps at the same time and take whichever ride pays better. Nobody is locked in. Second, the network effects are local. 1,000 drivers in New York do absolutely nothing for a rider in Houston. So Uber doesn't just win once, it has to win city by city by city. And finally, the returns just plateau. Think about it. Once the wait for a car is down to, say, 3 minutes, adding 100 more drivers to get it down to 2.5 minutes doesn't really change your life. The value just levels off. So if the market just isn't built for a winner-take-all ending, what happens when a company acts like it is? Well, this is where we get to the billion-dollar gamble. Just look at how different these two playbooks are. It's like night and day. If you think you're in a race to be the one and only winner, you burn cash like crazy on discounts to kill your competitors, you chase growth over everything, and you don't worry about profits until later. But if it's not a winner-take-all game, that strategy is a complete recipe for disaster. You have to focus on building a sustainable, profitable business that can handle competition forever. And Uber, well, they bet everything on that first strategy. The logic was really clear in their minds. Spend whatever it takes to subsidize rides, get everyone on your platform, drive competitors out of business, and then, once you're the only game in town, you can raise prices and finally make all that money back. And the price tag for this gamble? It was absolutely astronomical. At one point, the company was losing $1 billion a year in China alone, and that's a market they eventually had to pull out of. This is the real-world cost of chasing a monopoly that just isn't there for the taking. So, what was the final result of all that spending and that grand strategy? Well, it created this strange situation that you might call dominance without power.
So, what does this dominance without power actually look like on the ground? Well, in a typical big city, sure, Uber is the clear leader. They might have around 70% of the market. But Lyft is still right there, a very strong number two with the other 30%. Uber's the biggest player, for sure, but they can't just act like their rival doesn't exist.
And so, this is what the market actually settled into, a stable oligopoly. Uber is the leader, but because Lyft is always just one tap away for both riders and drivers, Uber can't just jack up its prices whenever it feels like it. It achieved market leadership, sure, but it never got the absolute pricing power that a real monopolist enjoys.
So the next time you're talking with someone and they declare a market is winner take all, you now have the toolkit to challenge that assumption. Just ask these three simple questions. Can people easily use competing services at the same time? Are the benefits of the network local or are they global? And do the returns just keep getting better and better, or do they eventually hit a ceiling?
And understanding the answers to those questions is absolutely critical, because betting your entire company on winning a market that was never actually designed to be won, well, that might just be the single most expensive strategic mistake a business can make.